No? Okay. Let's continue. So let me give you more terminology, the difference between real assets and financial assets. So basically, companies finance their real assets purchases by issuing financial assets. Like, what is a real asset? Real assets can be tangible or intangible. We talk about those. Like, tangible assets are like plant, property, equipment, machinery, factories, whatever. And we might have intangible real assets, which are patents, trademarks, brand names, R&D expenses, and things like that. And financial assets are everything that is related to finance, which might be stocks, bonds, bank loans, what have you. So these are all financial assets, and companies use those financial assets to purchase real assets. Let's go over those examples. So you're going to tell me whether it's a real asset or a financial asset, okay? Like a patent. Real asset, tangible or intangible? Intangible real assets. Don't get confused there. It's intangible but real, okay? A share of stock issued by Bank of New York. Financial asset. Exactly, it's a stock. A blast furnace in a steel making factory. Real asset, tangible real asset. It's a furnace, like oven, let's say. See, you don't even have to know that. Like, it's like an oven. It doesn't say anything about finance, so you don't have to know every word in an example, let's say. After a successful advertising campaign, potential customers trust FedEx to deliver packages promptly and reliably. Real asset, which is intangible, and it is like brand name, right? So customers basically trust FedEx. A mortgage loan taken out to help pay for a new home. It's a financial mortgage loan as a financial asset. Perfect. Okay, now let me go briefly over types of firms. This is a corporate finance class, so we're going to focus on corporations, but we should also know about other types of firms. One is sole proprietorship. It's basically owned by one person. It's very easy to set up. Like, think about bakkal amca, or think about like boutiques on the streets, let's say, on like one store owner, one store. Taxes flow through the individual. There's no separation of ownership. So the owner is also the manager. Think about the bakkal amca. Okay, it's the simplest example. Bakkal amca has unlimited liability. Bakkal means like, how can we, like small one? Like a small market owned by one person. You probably see it a lot in Ankara. Okay, in Turkey. Unlimited liability. There's no separation between the firm and the owner. Unlimited liability means if the bakkal is in trouble, the owner is in trouble. So for the death of the bakkal amca has to sell his own house, let's say. So there's no separation of the entity and the owner. And equity limited to entrepreneur's wealth. So the most entrepreneur can lose is his entire wealth, basically. Then there are partnerships. It's owned by two or more people. Taxes flow through the individuals again. There might be limited partnership or general partnership. In general partnerships, you also have unlimited liability. So if the company has some debt, you might be obligated to sell your own assets to pay off the debt of the company. In the limited partnership, you probably have limited management rights, but also which might look bad. But also the good thing is you have limited liability, which means you cannot lose more than your investment on the company. So if you put $50,000 on the table, $50,000 is the most you can lose because you have limited liability. We're not there yet. We're not in the shareholder, but in the corporations, we're going to talk about it. Okay, so partnership example, like doctors, they form partnerships. They have the practices, lawyers. These are all partnership forms. Then we have limited liability companies. This is very common in Turkey. In US, it's not that common, but Europe and Turkey, we have lots of limited liability companies. They're owned by a limited number of people. They generally have limited liabilities, and transfer of ownership is not very easy. So if you look at the US figures, here we have the percentage of the businesses in US. 70% of the businesses in US is sole proprietorship. Remember, the owner is the same with the manager. Corporations are 20%, partnerships is 6%, partnership is 4%, limited liability is 6%. If you look at the percentage of revenue they generate, corporations generate 85% of the revenue in the US economy. Sole proprietorships only produce 5%. So you can make the comparison. 70% of the businesses are in sole proprietorship, but they only have 5% of the revenue in the economy, which is not surprising. Of course, individuals generate less revenue than corporations. It's not surprising. Corporation, main focus of this class, is owned by unlimited number of people. How can it be possible?
They might give shares to their workers and employees.
Not just workers actually, but yeah. So
But also they open shares to the public.
Exactly. So think about Apple, for instance. Apple has millions of owners. We know like Steve Jobs and who's the new guy? Tim Cook. Yeah, we know those people, and we feel like they're the kind of the owners as well. But actually, when we say ownership, it's all about who has the stock. Of course, if you have more stocks, you have more ownership in the company. If one person owns 50% of the company, he's kind of the owner of the company, of course. But companies can issue shares to public, and they can sell it to the public. That's why they're called public companies when they do it. And anyone can buy the share. We can buy a share of a company. We can become owners. Limited liability is important. You pay the money for the share. Like you bought a share for $100, let's say. The most you can lose is that $100. That's it. So if the company goes bankrupt, and suppose that the stock price went to zero, okay, you lost your $100, that's it. So companies cannot come to your door and say, we have all this debt and we decided to collect money from our shareholders. Give me $10 more. No, you have limited liability. Transfer of ownership is very, very simple. One person sells her stock to someone else. That's it. Very, very simple. This is important. There's double taxation in corporations. What does it mean? As a CEO, let's say I took lots of investments, I generated lots of money. I have to pay taxes to the government, of course. So in the income statement, you probably remember there's taxes, and then at the end we have net income. So you pay tax to the government, and from net income, if I decide to pay dividends to my shareholders, dividend is money paid out to owners basically every 3 months or so. If I decide to do that, then the shareholders will have to pay tax on dividends. So the company is paying tax, then as owners, it indirectly affects you, of course. But then when you have the money, the dividend payment in your hand, you have to pay tax to the government. That's why we say there's double taxation. This is very important, separation of ownership and management. Suppose we all bought stocks from Apple and we're all owners, but owners are different than the management team. Management team is the CEO, board of directors, and everybody. So this separation of ownership is a good thing. It's also a bad thing because we're going to see there will be lots of agency problems related to that. But this is also an important thing for corporations. Okay, so Morgan Stanley and Goldman Sachs, for instance, they started their life as partnership, but then became corporations. Why do you think it's the case?
Because they need money to invest, so they issue stocks.
Exactly. As partnership, you can only you're in touch with little number of people, let's say investors. When you go public, you can raise more money. Do you remember like a recent IPO, initial public offering, which has basically become a step to become a corporation?
GoPro.
Hmm?
GoPro Inc. did it
Oh, okay. I actually didn't hear about it. Okay.
2 months ago.
2 months ago. Okay. I had like Alibaba in my mind, for instance, a Chinese company. Everybody's talking about the IPO. You're all familiar with Facebook and Twitter. This is not recent, but you probably heard about those. So when companies need more money, they decide to become public because by issuing stocks, they're kind of selling ownership to you, and they can raise lots of money. Also, after become a corporation, you can, if you're a reliable firm, banks will be more willing to give you money. So the bigger the company you have, the easier for you to find money from stockholders or from debt holders. Okay, very good. So basically, if you want to start business, like not to deal with legal procedures and everything, and if you don't need lots of money in the beginning, you start with partnership or sole proprietorship, let's say. Like you start with a startup company. Then as you get bigger and bigger, like you will be one day, then you're going to be a corporation. So you're going to raise more money and more people will know about you. Okay, any questions about types of firms? Okay, now let's talk about the corporate environments. And we talk about corporations. Who are the agents related to those corporations, let's say. So we have shareholders, equity holders, shareholders, stockholders, the same, who owns shares of the company. These are the owners. Then we have manager, CEO, board of directors. These are the management team. Remember, separation of ownership and management. This is important. We have debt holders. Who are debt holders? Like whoever the bank borrowed money from, the company borrowed money from, for instance, banks, or bondholders. Companies can also issue bonds, which are debt papers. Okay, you buy bonds from companies, so you're kind of lending money to the company, and then you will have interest payments periodically from the company, and then you're gonna get your capital at the end of the maturity of the bond. We're gonna talk about bond and stock valuation after the first midterm for a very long time. But debt holders can be banks or bond holders. Then we have society, government, and regulators. We have employees, we have suppliers, we have customers. So all those parties have some stake in the company. So these are all stakeholders in the company. Don't get confused. Stockholders are stakeholders, but not all stakeholders are stockholders. Okay, so for instance, debt holders are also stakeholders, right? So they are not the same thing. Stakeholder is the general name of all the agents in the company.
Is it stockholders and shareholders same thing?
They're the same thing. Stock, share, equity, they're all the same. Thank you for the clarification. Any questions? Okay, so now I'm going to talk about what role do they play in general, all those agents, and what do they want from the company. And we're going to talk about what should happen in an ideal world, what happens in real world, and how companies make decisions, what is the objective of the company. So before starting, let me ask you this. What is the goal of a company? As people who took the class before, please don't say anything. Okay. Don't say anything. What is the goal of a corporation?
To make profit,
What else?
maximize value.
Maximizing value. Okay.
Reputation.
Okay. What else? Maximizing market share. Maximizing social responsibility. What else? Okay, here is the goal of the corporation. Maximize the value of the firm is correct, but I was more interested in what do you mean by value? What is value? Because reputation might be the value to you. So the objective in this class, and always. The objective of a company will be to maximize value. I took those sentences from different finance books. When Horn says, in this book, we assume that the objective of the firm is to maximize its value to shareholders. Shareholders are made better off by any decision which increases the value of their stake in the firm. Maximize the wealth of its stockholders. Stockholder wealth maximization, which translates into maximizing the price of the stock. So, does it say anything about profit? Reputation, market share? It's all about maximizing the return to stockholders, maximizing the return to owners. And as owners, how do you think my wealth increases? I'm a stockholder in Apple. What do I want to see about the price of the stock? To go up. So actually, the goal of a corporation is kind of maximizing its price. All of the things you said were correct. Increase profit. Increase profit is a good thing, of course. It means the company is doing well. Increasing reputation, increasing social responsibility. They might all translate into increasing the price. But sometimes they don't, and we're going to talk about it. But the goal is to maximize the value of the company, maximizing the stockholder wealth, maximizing the price. Why am I repeating this as if I'm talking to fourth-year student, like little primary school student? Because we always ask a goal of a corporation question. And I hate it when some of you writes profit maximization. It's not. Especially econ people I know, I'm one of you. We always say, oh, profit maximization, but not the profit maximization. Why do you think profit maximization is not a good goal? Think about the shady things, bad things the company can do to increase profits. Oh, like pay less tax to the government to boost up your income. That's one thing. What else? So to increase profit, you either increase what? You increase, okay, there are revenues minus expenses, profits, right? Do I remember correctly? Okay. So increase revenues or decrease expenses. Think about the shady ways decreasing expenses.
In order to increase your profit, you might decrease the quality of the product that you're selling.
Exactly.
Or change the things that your customer might like.
So basically, she says, then decrease the quality of the products, then your cost will decrease, which will have bad long-term effects. But it's going to increase your profits this quarter or this year for sure.
So in these times, the most of the companies or corporations not trying to make more qualitative. They are trying to do same thing with less expenses, and this is also make more profits for them.
Oh, you're saying this is the situation right now, or this is what they should do? This is what they do. Okay. No, I think they're trying to increase the quality of the product, or like look at Apple Samsung war all the time. You definitely have a point, but I think now competition is so fierce. All the companies are trying to have different products, and if they focus on high quality group, like not all companies produce high quality products, of course. It's depending on strategy.
They are producing with same materials, but
Okay.
they are doing more of the, for example, they are using more machinery
Uh-huh.
instead of the labors, and it is decreasing their expenses, and it is
Increasing profit. Okay. I always give this drastic example. To decrease the cost, you can lay off lots of workers. You decrease the cost like crazy in that quarter and in that year, but for the long run, it has a bad effect for the company. So for profit maximization, again, the company can increase current profits at the expense of future profits. Think about Enron scandal. They figure out that they were hiding things for 3 years, 4 years or so, but then it exploded. So looking at profit only is not a good goal for us. Stock price, it's not that easy to manipulate stock price. You might have fake news, maybe, to boost up the stock prices, but probably the market will clear itself in a week or so. People will know what you're doing very, very, very fast. That's why stock price maximization or looking at stock price is a better thing for us. Also, for stock price, you can have immediate, every second stock price changes, and we can observe it as investors. For profit, we have to wait 3 months to see what's happening. So stock price is a good, let's say, good signal about, indicator, thank you. It's a good indicator of how well the company is doing. So it's not profit maximization. It's stockholder value maximization. Very good. Okay, so
Can I ask something?
yeah.
What is the aim of the company which has no shareholders?
Again, it's increasing the value of the company. In that case, increasing the value of the assets. I will just talk about it. Very good question. Okay, so remember the balance sheet again. We have assets in place, and growth assets. So remember, assets in place we're talking about current assets. And for growth assets, we generally talk about plant, property, and equipment, patents, R&D, and everything. So as you remember, the balance sheet should be balanced. So here you have debt and equity. So assets will be equal to debt plus equity. Do you remember that equality? Assets is equal to debt plus equity. Perfect. So as company CEOs, okay, we want to maximize the firm value. How am I going to maximize firm value? I will try to increase the value of the assets, right? How much assets do I own? So there are two things about assets. We have assets that are already in place, the assets you already have, which produce value. And also you have assets that will produce value in the future. Think about patents. Okay, so you spend lots of money on R&D, and it is kind of a growth asset for you to have only one patent. And having this patent, it's a very long process. Now I'm doing research on patents. It's ridiculously long process. After having that patent, it starts producing money for you. But it's a long-term investment for you. So it's a growth asset. You're going to grow the company in the future by having R&D expense now, basically. So this is you expect this part to create value for the company in the future. This part is what you already have, the short-term or long-term. So together, you're trying to maximize the value of the firm. The equivalent of maximizing assets part is maximizing debt and equity. So if you maximize debt, what happens? Right? For this to be balanced, to increase this part, there should be a matching increase in this part, which might come from debt, which might come from equity. If you have lots of debt, what is the problem with it? What might be the problem with it?
You lose some money because of interest.
Because of what? You lose
interest.
Interest. Also, think about the end of the tunnel. What happens if you have tons of debt? Bankruptcy, exactly. So increasing the value of the company doesn't translate into maximize debt. It's not a good strategy, because increasing debt increases your bankruptcy probability. So then we focus on equity. So if you are trying to maximize the firm value, maximizing assets, it should translate into maximizing the equity value of the company. One important thing is, this is the balance sheet. Is the balance sheet forward-looking or backward-looking? Backward-looking, right? These are the notebooks of the company, what the company did in the past. So this is the book value of equity. How much equity was sold, how much it was worth. Since we are interested in the company's situation now, we are interested in growth assets, the money the investments can bring. We should focus on, I don't have it. We should focus on equity value by maximizing the market value of the company. So what is market value of equity? How can I find the market value of equity? Book value of equity is in the books, in the balance sheet. What is the market value of equity? Equity is stocks. How can you find the market value of the stocks, shares the company has? Suppose that we all have iPhones, and suppose that they're all $1,000 on the market today. How do I calculate the market value of all the iPhones in this class? Çok basit bir soru. It's a very, very easy question.
Meant for that product.
You do what?
Meant for that product.
No, I'm asking very simple.
Sum up the values of the iPhones.
Thank you. In the class. So you basically do market price times number of iPhones, right? It's the same thing. Market value of equity, price of the equity times numbers of shares outstanding. Numbers of shares outstanding means how much the public has, how much shares the public has, times the price. How am I going to find the price? Huh? Where can you find the price of a stock? Any finance page, Bloomberg, you can find it anywhere. So let's look at this together. Okay. Tell me a company name. Huh? Apple? Is it Apple? That's, oh. Okay. So this is the price of Apple stock, $101. So if you're interested in market value of Apple, it's very shiny here. Okay, here. Market capitalization, this part is basically price 101 times numbers of shares outstanding for the company. It's also called market capitalization. So Apple can increase the number of shares outstanding by issuing stocks, but it's not a good trick. Why? How do you think the price is determined? Econ people, how the price is determined? Demand and supply, right? If you have lots of supply of stocks, then the price should decrease. Of course, with Apple, I don't know whether they will have this problem, but so issuing stocks doesn't make that sense that much. So the goal will be increasing the stock price. Ooh, Apple stock is what?
Going down.
Ah, but this is like daily thing. It's not a big deal. You can look at the historical chart for the price of Apple. They announced the new model, what, 2 days ago? Here? Probably here. Is it correct? No, they announced it, what? 9th? Okay. You see it here, right? So they made the announcement for iPhone with 6S, the clock, watch, whatever. So this is the market reaction. So the market was happy with the announcement, basically. The stock price increased. So of course, improving your products, improving quality, whatever, as long as you can announce it to the public in a good way, the public will react favorably. So remember, we are trying to maximize the value of the company by maximizing the market value of equity, by maximizing the price of the stock. It's not profit maximization. I'm going to kill you if you write profit maximization as the goal. Okay, not really, because it's on tape now. They would come after me. But I will be really, really sad. Don't write profit maximization, please. Okay. Okay, any questions? So suppose that we are focusing on GE now, another company. We promoted Apple more than necessary. So suppose that we have two investors in GE. We have Ben and we have Sandy. Ben is a 22-year-old investment banker that just invested part of his signing bonus in GE to begin saving for retirement. And Sandy is a 78-year-old retiree that uses returns from her GE stock to partially fund her retirement. So companies, when they issue stock, most of them pay dividends on the stock. So for each stock you own, they send you periodic payments, in general quarterly payments. So suppose that for GE pays $4 for each stock the people own. So if Sandy has 100 shares of GE, then she's going to get $100 every 3 months from the company, like a check. She's going to get a check. Ben is a young guy. He doesn't care about the money now. He's an investment banker making tons of money anyway. So he cares about long-term growth. But Sandy prefers short-term returns, right? She needs the money now. So how do you think those maximizing stock price goal works for both of those investors? They're completely different investors. Don't say that. No, she's fine. Okay. In US, lifespan is longer. Actually, seriously, like 70. There are lots of older people around there. She's not gonna die. Okay. How come increasing stock price is a good goal for both of them? Yes.
I believe that Sandy will pay her money to like Apple companies, which is make profit is regularly, and she believes that they cannot lose.
Mm-hmm.
But I believe that one can make some investments, some more critical corporations which can make more profit, or they can lose. How can I say? They can be bankrupt, or they can be go very well.
Riskier companies. What's your name? Efe. Efe has a point, exactly. This is what I was going after. So for every investor, increased stock price is a good thing, whether you're a short-term investor or a long-term investor. So even if you're a short-term investor, you can sell that stock, buy something else, okay? Enjoy the money you already did. Increased stock price might signal that the company is doing well and there are good long-term prospects. Like if there's a agreement, let's say, like that might turn into a patent. When it's announced, the stock price increases that day. Even if nothing happens that day, even the announcement related to a long-term investment might have positive effects on companies. So in that case, increased stock price might mean that in the long run, the company will do well anyway. So it's a good thing for both Ben and Sandy. So you enjoy the increased stock price. You can either sell your stock, or you can say the company is doing well anyway, so I will stick with it. So at the end of the day, as long as the manager is trying to maximize the value of the company, which means making good investments, and we're going to talk about this net present value thing at the end of the semester, projects with positive present values will add the value to the company. When you think about the company is not, it's like an entity which grows on investments. The better investments the CEOs make, the better the company will be. So it's a cumulative, the value of the company is basically accumulation of all the past investments plus all the future good investments. So future prospects and what happened in the past both creates the value for the company. My question to you is, should Ben avoid GE if GE pays off generous dividends? Let me just clarify, then I will let you talk. So we are going to prepare income statements, and income statement ends with net income. From that net income, the company can distribute money to stockholders as dividends or keep the money in the company as retained earnings. And those retained earnings can be used for future investments. So what are you going to say here?
No, because you prefer a company which keep the money to invest more because you prefer long-run investment because it's young. It's not the case of Sandy.
So Ben can think two ways. One, Ben can think, okay, I don't understand why GE is paying all this money as dividends. GE can just keep the money in the company and make investments that will bring me money in the future. Ben can think that way. Or Ben can say, you know, I will just get dividends and then I will make new investment. I will buy other stocks like from GE or from somewhere else. And also one more thing, companies, what kind of companies do you think pay lots of dividends? Small companies, big companies, mature companies. Mature companies, right? Why?
Because they already established their machineries, technologies, and this kind of things, and it is like an end of the road. They cannot make more investments to other places. Therefore, they need to keep their places.
Efe is right. Thank you, Efe. Exactly. So basically, a mature company doesn't have lots of investment in its pool anymore. It's already mature, it's already established, it's expanded and everything. That's why they pay off lots of dividends, which might not be a bad thing. If you're craving for long-term growth, it might not be a good thing for you. As Efe said earlier, if you're interested in, if you're young and if you don't care, if you're making money already, you might go after riskier companies, new riskier companies, which may fail in the future really bad, or they might be stars and you might make lots of money. So it depends on you. I'm gonna say last thing, we will talk about those financial institutions like pension funds, for instance. You know what pension funds is? It started in Turkey as well. It's a big thing in US. So basically part of your salary is put in a pension fund, like for Bilkent, for instance. Bilkent takes off some amount of money from my salary every month. I don't know how much, I have no idea. And they put it in the fund, and then they buy assets, financial assets, with all those money people have. And when I retire, or when I decide, if I decide to quit Bilkent, then if the fund generated lots of money, I can get that money from that fund. So it's a big thing. We will talk about those later. They're big investors. And actually, they generally pick companies which pays dividends. Why? Because since these are pension funds, they cannot risk your money like crazy. So they go after more mature, dividend-paying companies anyway. Okay, I think I'm off the track, but okay, it was just little information about finance in general anyway.
There's also helping funds.
What funds?
Helping funds in the companies, some companies.
For the employees?
Yes.
Yes. It says something. I don't think in Turkey we have it though. Let me look into that. Okay, so to sum up, we are interested in maximizing the stockholder wealth, which translates into maximizing stock price. And in your question, if the company doesn't have shareholders, you're trying to increase the value of the assets. Okay. And we are using this. Why? Academically, we have lots of theories using stock price. It's a good variable for us to use. It's easily observable. You can go to any finance page and find the stock price of any company, any public company right away. The question we have is, do managers work for this goal? Before going, I will show you a couple more slides and I will let you go. It's already too much for the first day, probably. So remember I said finance is all about riskiness of and timing of the cash flows. So let's look at all those things and how it's going to affect the stock price of company. Suppose that we are thinking about one big investment, which is very important for the company. And suppose that in the future we expect lots of inflows, cash inflows related to this project. How is it going to affect the stock price? Is it going to increase the stock price or decrease? If you expect lots of cash inflows, is it going to affect the stock price positively or negatively? Again, very simple question. There's one big project. You expect lots of cash inflows because of that project. Is it going to increase your stock price? Decrease? Increase. It's a good thing. If you expect lots of cash outflows, it's going to decrease your stock price. Wonderful. Timing. if you expect the cash flows to start next year, is it going to affect the stock price better compared to when your cash flow will come like at the 20th year? It's better to have it sooner, right? Okay, very good. Of course, this is ceteris paribus. Okay, all else will be equal whenever we are focusing on one thing. And last thing is riskiness of future cash flows. Degree of risk decreases. Is it going to affect stock price positively or negatively? Positively, right? If the degree of risk decreases, we're going to see this later. Cost of capital is decreasing. In that case, because of time value of money, we are going to see it later. The value of the future cash flow of today will increase because you are more sure about what that cash flow will be in the future. So this is going to affect the stock price positively, and the opposite will affect it negatively. So to sum up, let me remember what I have. So companies might have lots of different goals, like increasing sales, increasing market share, reducing asset requirements, becoming more tech-oriented company, whatever, like marketing strategies, or the manager might use different financing decisions to debt, or are we going to use debt, are we going to use equity, or what type of debt, short-term, long-term, what kind of stock we're going to issue. These are all related to managers acting to increase the value of the company. But please don't forget, we are trying to maximize the market value of the company, and we are trying to increase basically the stock price of the company. That's important. Yes, the planet got destroyed, but for a beautiful moment in time, we create a lot of value for shareholders. This is basically what the companies are doing now. Okay, thank you so much for your patience for the first day.